Welcome to this explainer. Today we're tracking a massive shockwave that is literally rattling the global financial system. We're talking about a bond market earthquake unlike anything we've seen in recent history, and, well, we're going to figure out exactly why it's happening. Let's kick things off with a pretty staggering number, 5.33%. The 30-year Treasury yield just hit a high we haven't seen since the George W. Bush administration. And the 10-year yield? That's hovering right around 4.74%. Guys, these aren't just your standard everyday incremental bumps. These are monumental shifts in the absolute bedrock of global finance. Okay, let's dive into this, because this next stat is truly wild. Think about this. If you had bought a 30-year Treasury bond just 3 years ago, you'd be sitting on losses of over 40% right now. We are not talking about some volatile, risky stock market crash here. No, we are talking about an unprecedented implosion of what is pretty much universally considered the safest asset on Earth, U.S. government bonds. And look, when the bedrock cracks, the alarms start going off everywhere. You've probably seen these panicked financial headlines from CNBC to Bloomberg. The world is waking up to a really harsh new reality. But make no mistake, this Wall Street problem is rapidly becoming a Main Street reality. This directly impacts your money, and we're going to see exactly how. Section 1. The perfect storm, supply, inflation, and the Fed. So there are three main drivers creating this crisis right now. We've got a massive supply shock, the return of inflation, and some serious policy uncertainty from the Fed. Let's break down exactly how these three are interacting to push yields straight through the roof. Now, what's really interesting about this slide is the sheer scale of the supply shock. The U.S. government is running a $2 trillion annual deficit. That is basically burning through the equivalent of Australia's entire GDP every single year, just to keep the lights on. And to fund this, they're just flooding the market with bonds. But at the exact same time, corporate giants, think Alphabet, are fiercely competing for that very same pool of money, issuing massive $25 billion bond deals to fund their AI arms race. So the market is absolutely drowning in supply. And you know how it goes. When supply skyrockets while demand stalls out, bond prices fall, and those yields inevitably rise. Driver number 2, inflation is back in the room. Oil prices have actually spiked over $90 a barrel. And this is largely due to renewed tensions in the Middle East, the expiration of an Iran ceasefire, and some critical shipping lanes getting compromised. Now, higher energy cost means higher prices for literally everything, from the gas pump to the grocery store. Bond investors see this inflation thermometer rising, and they're basically saying, hey, we demand higher returns to protect our money. And that brings us to our third driver. Federal Reserve figure Kevin Warsh has totally broken with tradition here. Unlike his predecessors who constantly telegraph their moves, Warsh has gone completely silent. There's zero forward guidance right now. And when investors are forced to play this guessing game without a clear playbook from the Fed, well, they get nervous. And when they get nervous, you guessed it, they demand a higher premium for taking on any risk. Section 2. Decoding the jargon, what the market is telling us. Okay, so you're going to hear the phrase bear steepening everywhere right now. I know it sounds like some intimidating camping scenario, right? But it really just means long-term interest rates are rising way faster than short-term rates. And honestly, both are going up. This tells us the market is no longer just holding its breath for the Fed's next immediate move. Instead, investors are deeply, deeply worried about the government's ability to manage its long-term debt, as well as the sheer stubbornness of this inflation. Which leads us directly to the term premium. Simply put, this is the extra compensation or the extra yield that investors demand for locking their money away in long-term debt. And this premium has absolutely exploded in recent weeks. Why? Because investors are terrified of being stuck holding long-term bonds if inflation just stubbornly refuses to cool down. So the absolute crucial point here is that investors are fighting back. We're actually seeing the return of the bond Vigilantes. It's a throwback term from the 1980s, describing investors who basically punish governments for bad fiscal policy by dumping their bonds. Your Donny Research, the firm that actually coined the term, warns that the 5% line on the 10-year yield is the critical threshold to watch. If we cross it, this massive sell-off could accelerate really, really fast. Section 3. The Main Street Impact. Your wallet on the line. And this brilliantly illustrates the agonizing reality for homebuyers right now. Think about a standard $400,000 home with 20% down. Back in 2021, at a 3% rate, your monthly payment was about $1,350. Today,
With mortgage rates hovering around 7.5%, that exact same house is going to cost you $2,240 a month. That is a brutal difference of nearly $900 every single month. For millions of families, this is the stark line between owning a home and being entirely priced out.
But unfortunately, it doesn't stop at housing. Banks are passing their higher borrowing costs directly to us, the consumers. New car loans are approaching 8%. Credit card rates are pushing a staggering 25%. Meanwhile, rising guaranteed bond yields make the stock market look way less attractive, which puts intense pressure on your 401k, particularly those tech stocks in the S&P 500. And perhaps most importantly, as borrowing costs rise, companies just stop expanding. They delay hiring. It acts like an absolute cold shower on the job market.
Section 4. The global ripple effect. The tsunami spreads. Now, when U.S. yields go up, everybody else's borrowing costs surge right alongside them. Over in the UK, the 10-year gilt yield has hit levels we haven't seen in over a decade. Germany's bund yields are rising too, creating intense stress all across European debt markets. And Japan's government? They are watching in absolute dismay as their massive, historic debt pile suddenly becomes incredibly expensive to service.
Plus, these high yields are actually pushing the US dollar higher. And hey, while a strong dollar might sound like a good thing, it actually makes American exports way too expensive for the rest of the world to buy. Even worse, it absolutely punishes emerging economies, places like Turkey, Argentina, and Indonesia. See, these countries hold large amounts of debt denominated in US dollars. So as the dollar strengthens, their debt payments suddenly become unmanageable, which becomes a real threat to global stability.
Section 5. The crossroads. Where do we go from here?
Let's move to and see how this builds, because as we look to the horizon, the market is facing two very distinct futures. Scenario A is the path to relief, lower yields. But honestly, getting there requires a near miracle. Congress and the White House would need to drastically shrink the deficit, corporations would need to cool off their AI borrowing, and oil prices would have to drop significantly. Now, on the flip side, look at scenario B, the sell-off continues. If we actually cross that 5% line on the 10-year yield, we're looking at further stock market corrections, a severely tightened economy, and some mounting, desperate pressure on the Federal Reserve. Which leaves us with this massive, looming question. Can the Federal Reserve actually do anything to stop this? They're kind of trapped in an impossible dilemma right now. Theoretically, sure, they could step in and buy bonds to try and lower the rates. But doing that while simultaneously trying to fight inflation, it's completely contradictory. It would basically signal to the market that the Fed is in sheer panic mode, which could, ironically enough, spark an even more aggressive sell-off.
And that brings us to our stark bottom line today. The bond market is speaking with one unified voice. The era of free money is truly over. The market is now demanding real compensation for real risk, which is forcing a fundamental rethink of how we invest, how we borrow, and honestly, how governments spend. So, as we watch the yield curve chart its next dramatic move, I'll leave you all with this thought. If the safest asset on Earth is no longer safe, where exactly does the global economy hide when the next storm hits?